Good morning, everybody. It is June 27th, 2017, and you are watching MarketStream.live, and we are checking out everything that's hot on the open here in the United States. And it has been an interesting open, to say the least, especially after what was mixed action in the Asian markets overnight. And now we are seeing that Europe, well, ECB President Draghi came out with some pretty hawkish statements, really woke up the bond bears. That shook the global bond markets. Right now, the bonds are down. We'll touch on that in a second. We also have some notable weakness in tech, and that's what's been driving some of the action most recently. But let's start on the VIX, and this is our fear index, right? It's at historic lows. It did pop up. It's off of its best levels. It was high as about 1030, about up 2.5–3%. It's pulled back. The VIX is right now at 10, even up 10 cents. This is your barometer. As you start to see markets move, and maybe you think, oh boy, this is it. It's going to finally start moving against me. Just look at the volatility index. It's at historic lows. Until you start seeing this in the 15, 17 range, I'm not seeing anything that's going to be notable as far as volatility or fear of violent big moves. With that being said, we want to take a look at the large cap indices. We'll start with the Dow Jones. Opened up this morning down up 9 cents, and basically has stayed at this level, waffling back and forth from break even. Now, what's notable here is, again, watch that 20-day moving average at 21,293. That's where the short-term bulls will be knocked on their heels if, in fact, the market does start to become weak. Otherwise, they're going to have to catalyze to get off of these current levels that they're at in that 21,400 level. Taking a look at the S&P 500, similar action. Very grindy, right along the 20-day moving average. It's above there, so the bulls are still in control, especially in the short-term basis. But we're going to watch this because while the financials should benefit from the fact that bonds are pulling back right now, and they are one of the largest components of the S&Ps as well as the Dow Jones and the Russell 2000, here's the thing, though. There could be some profit taking, especially since we are getting into the tail end of this week and there's going to be a long extended market closure. There's a half day on Monday and then Tuesday's close next week. Plus, we're supposedly going to get some sort of provisional vote from the Senate on the healthcare bill. Senator Ryan came out and said that, yes, they're going to push forward that vote. But it doesn't look like they have the votes right now. Let's see how that ruffles the feathers of the markets. There's one other point that I want to put out there is the consumer confidence came out, and it was up. It was up to about 118.9. What does that mean? Well, the expectation was right around 117.9, or 116. A little bit higher than expected. But what will also occur was there's a small revision in the May consumer confidence from 117.9 to 117.6. What does this mean? What is really the fallout from this? Bottom line is the consumer seems to be tailing back because usually you hear the June swoon. You see some spending, you see, summertime, people are out enjoying themselves. Consumers really drive this segment of the market at this period of time, and we're not seeing it. That could have been reflected too. You could have seen that a mile away with what was going on with the oil markets and also the gasoline markets. But right now, S&P is down 360. Again, the level you're going to want to watch on the S&P 500, specifically the SPX cash, is going to be 2,430. Break there means the short-term bulls are on their heels. Taking a look at the NASDAQ 100, this is what's interesting is large cap tech has been driving this market, throwing it on its back. There's 5 to 10 names that are notable. I can give you a handful of them. You hear them every day. Facebook, Apple, Amazon, Netflix, Google. Google, by the way, got slapped with a $2.4 billion fine from the EU. Basically, the EU Commission came out and said, hey, guess what? You were favoring some of your business in your search results? Nuh-uh. 2.4 billion euros fined. That's weighing on Google. But you also have NVIDIA. NVIDIA, though, is an interesting story. This has been a darling of the market, but the reason why I think this has been such a huge darling is because of the fact they're using those chips in the self-driving cars. And those are gaining more and more traction. So if they are the provider of those chips that go into those self-driving cars, the larger that universe expands, the more NVIDIA could benefit. But the NASDAQ has been the weakest so far, bouncing off of its lows, but here's what's critical. I want to point this out. It's below its 20-day moving average. You see the short-term bulls are on their heels right now. They got to dig them in. Next level of support is going to come in at 56.76 on the NASDAQ 100. If you're trading the Qs, and in full disclosure, I do have my clients in a position in the Qs, which is the ETF that tracks the NASDAQ. It too is below its 20-day moving average at 140, trading at 139.74. Next level of support comes in at 138.33. I'm going to watch that one very closely. A break of that level means that there could be a trend change, both on a short-term trading side as well as more of on a institutional side. The institutions might be taking some profits for whatever reason. We'll have to watch the headlines, see what the action is telling us. But right now, that is also the index in the sector that has the highest implied volatility rank. Obviously, with the last move they had a few weeks ago with that pullback, they've only been up about 0.4%. As a matter of fact, if you go back, I don't want to jump around too much, but if you go back, they're only up 0.4% right now, and actually a little 0.2% from the lows that we had when they originally pulled back a couple weeks ago. This is something to watch, folks, because there was a battle, a grind, and there wasn't a lot of conviction to the upside in tech. That is a potential yellow flag at this point in time, not yet a red flag until we start seeing a challenge and potentially break that 50-day moving average. Small caps holding up quite well. Probably the best performing index at this juncture today. These domestically centric stocks are holding up probably because finance. And as a matter of fact, if you take a look at finance, let's see how XLF is actually holding up today, up 7 cents. This makes sense. With the bonds pulling back, finances are going to hold up. So both the larger institutional banks as well as the smaller regional banks are holding up. We'll see if that continues throughout the day. But the Russell and the small caps are holding up quite nicely. And also you start to see crude getting into that $44 range. As I've said, this is the level, the sweet spot that I think crude is going to kind of hang around right now. I think it's going to have a lot of resistance at 46, 47 level. And then that next sweet spot of resistance area is going to be where the last level of support, which was right around $48. A little bit, it's in between its 200-day and its 50-day moving average, which kind of is reflected in the red line and the black line. But clearly, the bears are still in control, both in the West Texas contract as well as the Brent contract. You continue to see that slide. What has bounced this morning and what's notable is gold. Watch gold closely. You're going to want to watch it at the 1255 mark, and then you're going to want to watch it again at the 1257 mark. A breach of those levels means that gold bulls are starting to gain some traction. What's also holding up is the non-ferrous copper markets. Watching industrials is one of the weakest sectors right now, but copper holding up, that's a positive sign for industrials as well as potential infrastructure plays. We'll watch this one very closely. The housing data that has been coming out as of late has been positive over the last week or so. That is a huge driver. Globally, we're also seeing that there's a firmness. China has come out, some positive numbers out of China, and they're ready for globalization. They're welcoming it. So there's a lot of positive results coming out on that. Right now, copper's holding above its 20 and its 50-day moving average. The bulls have taken control. Let's see if they can hang on. As I had discussed, the bonds pulled back this morning and continue to slide. In full disclosure, I do have a position on for my clients in the bonds. You can see that it dropped precipitously this morning, down $1. That's pretty significant in TLT. That's good for almost 0.8% to the downside. We're going to watch this one very closely, especially since we've gotten some hawkish comments out of Europe as far as their interpretation. ECB President Draghi came out. He said, hey, this short-term low inflation markets, we don't think that this is going to be sustainable. We think it's just a blip in the radar. We think not only is inflation on the forefront, but also growth. With that being said, you're seeing that mixed market in Europe, but holding up. The euro strength is hurting those markets right now. It's helping both the commodity markets and it's helping the U.S. securities markets hold up, but it's definitely not helping the bond markets. You have treasuries down. The 2-year on the short end of the curve is down 0.5%. The 10-year is down almost 0.4%, and the 30-year is down almost 0.7%. So that's weighing on the bond markets. Price is coming down. That means that you will start to see yields come up. That's another plus, potentially, or a catalyst that's on the forefront for equities, if in fact they want to go into U.S. equities. Remember, growth is the key. And if it looks like either Europe or Asia is coming out of maybe some downward cycles, we've seen China come off its lows. We've seen some challenge in France, Germany. The UK has been moving to the upside and probably one of the better performing. But they're going to start to look for names and sectors in foreign entities that aren't really giving you that clear diversification, but it's giving you that growth factor that you need, that you may not be finding in such names as the FANGs or maybe some energy names or some banking names here in the States. So let's keep an eye on all of this action. And of course, we will be reporting on it, talking about it more and more here at MarketStream.live, as we do every day. So join us, spread the word, hit the like buttons on Facebook, get more people looking at this, and go to the website to check out our premium content. Also, join me at Strategy Now at 1:30 Eastern, 12:30 Central Time. I'm going to be talking about a poor man's covered call. We're going to build off our discussion how we're using longer-term options, specifically calls, to replace your stocks. And we're going to start selling options against that, like a traditional covered call. And I'm telling you, folks, these diagonal strategies have been working very well in this low implied volatility market. So while that still continues, this could be a great opportunity for you to free up some capital and still participate in the markets. We'll see you soon.